Analysts at Vetiva believe that while hopes for a global economic slowdown might offer Nigeria some respite from inflationary pressures, some domestic shadows, they say, threaten to cast an unsettling gloom for Nigeria's 2024 outlook. And we have Ibukun Omoyeni, is a macroeconomist for Sub-Saharan Africa at Vetiva Research. He joins me now to unpack their outlook for the region. Thank you so much for your time today, Ibukun. And let's first start with your outlook for the Sub-Saharan African region.
Thank you very much for having me. Looking at SSC in 2024, one key feature we are seeing is looking at the two major economies, South Africa and Nigeria. South Africa has been weighed by power cuts in 2023, while Nigeria has seen lower production. But in 2024, we expect that power situation in South Africa will actually improve, while oil production would actually rebound in Nigeria. I'm more looking at other countries like Niger, as well as there's a lot of hydrocarbon projects. That means a lot of new oil projects are coming up across these countries, especially for Angola. Between 2024 to 2025, we are seeing new refineries come on board. So this actually is going to boost outlook for the Sub-Saharan African economy. More so, you are going to see a dovish U.S. Fed. We expect that during the course of 2024, the decline in inflation will cause the Fed to begin to cut rates, and that would actually support growth in Sub-Saharan Africa. Overall, we think that IMF thinks that SSC is going to grow by about 4.1% in 2024. This is hinged on, of course, these new projects that are expected across these countries. And we expect that coupled with the monetary easing in the U.S. Fed, that will support growth in Sub-Saharan Africa.
So let's go back up to Nigeria. And then during your report, I see that you mentioned three key risks that stand out for Nigeria. You talk about the possible reemergence of subsidies, petrol subsidies. You talked about also oil production challenges, as well as the access to external financing. I'd like you to put in perspective for us how you see these threats or manifesting or not in the coming year.
Okay, so the risks to the outlook, looking at 2024, Nigeria actually has no external Eurobond maturity. So there's more or less pressure on the external side, but of course you're going to be servicing payments. We note that if we see a huge, for instance, a decline in oil prices, that could actually dampen efforts to ramp up reserve. Last year, we saw production improve. We saw prices quite elevated, but yet we did not see reserves grow. And what we understand now is that a huge portion of it, about 97% of our gross reserves, are tied up in FX forwards, OTC futures, and swaps. And what that means is that the CBN has less room to intervene in the currency market. So once you have an oil downturn or possibly reemergence of forced subsidy, in 2021 we were actually using our oil revenues to pay off subsidies. It was net, it was a zero. So we think that if subsidy reemerges, even if you want to slow down the price pressures, it will actually lead to more severe impacts on the FX side. So we think for Nigeria, more needs to be done. When we look at our FX has not been following trade. It has not been following trade indicators. It has been following reserve to money-based indicators, which means that the rate at which Nigeria has expanded money supply over the past 4 or 5 years is driving the parallel market rate. So we've seen a 92% correlation between money supply expansion and the parallel market rate. And we think ways and means is also a key driver of this outcome. So we think that measures to repay that ways and means or reduce money supply or increase reserve significantly would actually improve currency outcome.
Yeah, because talking about the parallel market rate, I see that you're estimating that we can see that go as high as 1,542 USD this year. And I'd like to get your thoughts around likely devaluation concerns that you see playing out for the Nigerian economy.
Definitely, we see that the parallel market is a leading indicator of where the official exchange rate is going to be. And we think that given the dynamics of not just of trade, but of money supply and external reserves, we think instead that we're going to see a significant boost to reserves, or we see that decline coming when you look at the exchange rate. So money supply has been growing excessively, and because when you grow money supply without growing output, there's going to be room for arbitrage. A lot of people are going to take out that money and take it to foreign exchange. And we know that for the past 4 years thereabout, interest rates have not been that favorable in Nigeria. So because of the low interest environment, it exacerbated the pressures on foreign currency, and that's why you are seeing a lot of funds going out of the country. So it's not just an issue of improving trade, because when we saw subsidy removal, oil imports fell by 7% in the month of June. That naturally should lead to an appreciation in Naira, but it did not. But that was because Nigeria had expanded its money supply so much and grown its reserves by so little, and at the end of the day, what you're just seeing is just like an interplay of your reserve growth with your money supply growth.
Definitely quite a lot to consider, especially when you look at what's playing out, especially externally with the geopolitics as well, talking about even the global interest rate environment and even the Sub-Saharan Africa debt burden. But I guess it's got a lot for us to digest as we continue to look forward down the year. Thank you so much for your time. Ibukun Omoyeni is a macroeconomist for Sub-Saharan Africa at Vetiva Research.